Hey, it's Joshua Belanger of Countervest, and I'm going to talk about why this stock is going to possibly be the next breakout or even takeover. Takeover in the next 25 days. Yep, they're on the clock, and I'm going to tell you why. So, right here, we're looking at Berry Global, and Berry has been a stock that has been drifting higher. Stocks go higher, so why not Berry, right? So, right here, we see prices pull back a little bit after hitting a high on Friday at $63. Now, just recently, the thesis for possible breakout is because Jeffries came out last week and they upped their target from 70 to 73. I don't really pay too much attention to uh, you know price targets or upgrades or downgrades, but hey, should be something we discuss, right? Could be something useful. So when we look at this right here, I mean, obviously the trend of this is going higher. It's drifting higher. It's holding the 10-day and the 20-day here on the moving averages. It's drifting higher. It's going higher. It looks to be that way. You get some pullbacks, but then it rips higher. So if that is the case, you're looking at momentum indicators. Why not break out, right? Get a pullback, and then you have some earnings here to be aware of coming into May 3rd or May 4th here. So the thing that really stood out today, why it possibly could be a takeover, is if we look in the options here. Now, I don't have to hide it from you. When you start to look underneath the market, what do we see here? Well, we see in 32 days, all of a sudden, there's this big, kind of looks like a sore thumb to me. You got 3,000 contracts traded on the 67 and a half call here. You had an open interest of 29, and this is coming off of Friday expiration, where typically you see positions being rolled. Something to keep in mind there. But all of a sudden, we're seeing this new accumulation with expiration on this 32 days. 32 days to expire. So now they're on the clock. Something has to happen. 67 and a half or bust on this position here. The thing that really stood out to me, we'll walk through it. It's no secret that I follow what I refer to as hot money. General terms, unusual option activity. That would be considered unusual. Why is this unusual? Well, overall volume on this one, we see calls traded in focus specifically in that strike, 3,200 calls with 141 puts. So calls dominated puts today. Specifically, these were being bought. And you can just look here on Thinkorswim's Thinkorswim here, and you can see 70% of those traded. It says between the market here, but the caveat here is you want to look to specifically see between the market here. So if you notice, the market at that time was 40 by 80. They came in, took a big whack of a block, and executed at 70 cents. And that's where things got really interesting, and we see the market kind of tighten up from there. So we start to see it get from 60 to 75, and then towards the end of the session, 70 to 75 here. So you can see where the biggest trades took place. This may look like these are sold because they were traded they traded at 70, 75. But I'm specifically sure this is where the theoretical was going to be put. Theoretical price on this is at the time when this executed was at 66 cents. And theoretical is just the theoretical value. Obviously, when implied volatility starts to tick up on this one, this is where you start to see the pricing of those options increase. So the heavily focused here on the 70 strike, buying, these are bought. These are being bought. Now they're looking for this move to happen. And the reason why they're most likely bought is you look at the execution on this one, and you can see where these were initiated by a buyer. So that's what we come into. Now there's many reasons people sell. There's only one reason why people buy options, because they think it's going to go higher. So instead of trying to chase this activity here and fight against the push in implied volatility here, what I was looking to do was to sell the 67 and a halves and buy the 65. So put a spread here on, and I was trying to do this for 60 cents, and it looks like I didn't get filled on this one. I thought I did. That's a different trade there. PBR. Oh. So it looks like I didn't get filled on this one, and so it looks like it closed at 65 cents. So that's probably the reason why I didn't get filled. well, obviously the reason I didn't get filled. So I was trying to get at 60 cents here, 60 cents on a 2.5 point spread. So that would leave $1.90 of upside. And this would help with the next 32 days because what's going to happen here is those 65 and a halves, they're going to come down in value. Also, the market was pretty wide at the time. So you're going to get some slippage in there as well. There was 40 by 80 at the time. They came in at 70 cents, executed and got filled, pushed the market. So this is what happens with unusual option activity. A lot of times you get this rush of out of the money call buying. It's not necessarily, it's a good signal, but it's not necessarily the best way to trade it. So sometimes when you look at the overall structure of the market, it's better to be a buyer and a seller here. So if you're playing the direction here, which is a directional bet, if these people are buying, they're looking for direction. They're looking for a price movement higher. Yeah, you get a little bit better of an outcome on this if you are trying to buy one and sell the other. And if you look at the implied volatility here, the 65s, they're 30 at the close here, and you're able to sell the 67 and a halves for 30.23%. So that actually helps offset the IV crush that's going to happen here. So what we're going to see tomorrow, very likely, is this IV, this implied volatility. Probably my guess is going to be about two points that comes out of here. And by buying one and selling that one, it helps offset that. So you could probably, if I got filled on this one, I probably would have seen a little bit of a profit here. So as this goes higher, you're capped at 67 and a half. But look, the reason why I'm saying this could be a takeover is that this is a $62 stock. It's easy to borrow. It's been doing very well. It's competitive. We have a $70 price target on here. Money right now is looking for a home, and things are being bought up. Companies are being bought up. This could be one on the market here that could be looking to do it. This is the kind of activity that we typically see on this. And with 32 days, something could be in the pipeline. So the main thing to me is that when you see something come in, you see this activity all of a sudden explode, and it comes in with 12 minutes into the close. You had all day to trade this. You had all day to accumulate a position, but all of a sudden you come in and just like that, you need it. You have to have it. I want it now. What's up with that? So you couldn't wait till tomorrow. You couldn't have done it earlier. All of a sudden I need it now. That's interesting. That's why unusual option activity can be useful. You have to understand what unusual is. This would be unusual. So that's what I have for you today. Make sure you like the video, subscribe, leave your comment below. Breakout, takeover, or even bust. Let me know. We'll see you in the next one. Take care.